Sure. Cindy Butts, unable to join us today. Wendy Clark.
Here.
Heidi DeWeingart.
Here.
Claudio Gualtieri. Commissioner Mascara Bruno is not joining us today. Matt Puglisi.
Here.
Matt, how do I do with your last name?
Great.
Okay. Lisa Tupper Bates. Greg Rigalde.
Here.
Great. We do have a quorum in attendance for the meeting.
Okay. Great. All right. Well, good afternoon, everyone. Thanks for joining. The first item on our agenda is the resolution regarding financing of 85 Tremont Street, Section A, and to be presented by Colette.
Hi, good afternoon, everyone. If it's okay with you, I'm gonna talk about both Section A and B and kind of split out the financing. Okay.
That's fine. Thank you.
So we've got two agenda items here for 85 Tremont Street, Section A, which is a 4%, and Section B, which is a 9%. This is a hybrid transaction. So on the 4% side, the board action request is for approval of tax-exempt bond proceeds for a construction permanent first mortgage loan of up to $15,200,000, as well as CHFA subordinate financing of up to $1 million. On the 9% side, the board action request is for approval of taxable bond proceeds for a permanent only first mortgage loan of up to $2 million, as well as CHFA subordinate financing of up to $1 million. So this is an adaptive reuse to a historic complex in Meriden. The 4% side of the transaction is 27 units, which are all affordable, 3 supportive housing units. The 9% side is 55 units, which include 11 market rate units, 44 affordable units, 11 supportive housing, for a total of 82 units. And to be clear, this is one building. It is a brownfield site, and it will be remediated as part of the redevelopment. The project will benefit from an 8-year property tax abatement. There'll be a condominium legal structure formed to separate the 4% and the 9% components. Income averaging minimum set aside will be employed on both sides. And enterprise green community certification is anticipated, and solar panels will be installed on the building's roof. There's also significant investment plans in the adjacent area by the city of Meriden. An investment of $2.25 million is slated for redeveloping the North End Field, which is adjacent to the site. And there are also plans to improve 2 nearby parcels. So all of these efforts will transform almost an entire city block. The developer is Trinity Financial. They've developed several properties in CHFA's portfolio, including the 3-phase large-scale redevelopment of Washington Village, which is now known as Soundview Landing. Phases 2 and 3 of Soundview Landing were developed using a hybrid financing structure. The GC is Enterprise Builders, and they've worked on a number of projects in CHFA's portfolio, including Clover Gardens, Forest Court, the Faxon, and Millport Housing. The architect is the architectural team, and they've designed the Tyler in East Haven, which is a CHFA property and an adaptive reuse of the former East Haven High School building. The property manager is Trinity Management, and they have an identity of interest with the developer. They manage approximately 8,700 units of housing, and they currently manage 2 properties in CHFA's portfolio. The development team currently has 8 LIHTC properties in CHFA's portfolio, 5 of which have financing with CHFA, and all of these properties are currently in CHFA and LIHTC compliance. As mentioned, this is a property located in Meriden. It's in an area with a mix of industrial, residential, and multifamily developments. There is a Stop and Shop grocery and the Meriden Mall are about a half a mile from the development. And according to the Affordable Appeals List, it is estimated that approximately 17% of the housing in Meriden is designated as affordable. The neighborhood is noted as low on the Opportunity Index scale. The cost will be shared between the 9% and the 4% deals using a pro rata share of the units. In addition to the requests made here today for CHFA resources, both the 4 and the 9 will utilize LIHTC equity, federal historic tax credit equity, state historic tax credit equity, CT Brownsfield municipal grants, DOH federal and state funds, DECD community investment funds, energy rebates, solar tax credits, and deferred developer fee. On the 9% side of the transaction, Key Bank will be the construction lender, and that is estimated to be about approximately $24 million loan. Key Community Development Corporation, excuse me, will be purchasing the LIHTCs as well as the federal historic tax credits, excuse me. With regards to rental subsidies, we have 811, 3 units on the 4% side, 811 units on the 9% side. These are supportive housing that will target formerly homeless households. There are 17 commercial tenants. All tenants will need to be permanently relocated, and that process has already started. We have at least 7 tenants that have moved out, and 3 more are in the process of moving out. The strengths of this project include the fact that it's an adaptive reuse of a 4-story historic mill building. It is remediation of a brownfield site. Design ensures that the building's original ceiling beams and columns will be exposed. SHPO and the National Park Service historic approvals have been obtained. The development team is experienced and has successfully completed 2 hybrid transactions with CHFA. The challenges include the fact that this is an expensive project with a high TDC and hard cost per unit. It does exceed our typical range. This is a historic adaptive reuse and a remediation of a brownfield site, which makes it complex and challenging and expensive. The developer has elected to use a 7% hard cost contingency instead of the 10% due to the extensive due diligence they've reported to have conducted at the property. Some of the mitigating factors associated with those challenges include the fact that the remediation and the relocation, the high cost per unit is largely attributable to the fact that we're relocating tenants. There are prevailing wage rates associated with the project. The historic improvements are all contributing factors. And when we looked at all these costs, they were within reason when these factors are considered. The level of CHFA financing and DOH soft financing is comparable to other deals with lower cost per unit. When you look at the CHFA loan amounts per unit, they're very low. So on the 4% side, we're looking at approximately $35,000 per unit for just the perm loan, and with the subordinate financing, it's about $71,000. On the 9% side, the permanent loan per unit is again approximately $35,000. For both loans, it's approximately $54,000. The developer was able to obtain a competitive equity raise, which brought some additional capital into the project. This is attributable to the fact that they'll be the construction lender on the 9%, and they'll be purchasing both the LIHTC and the federal historic tax credits on both the 4 and the 9 transactions. In addition, there is a T-Mobile commercial income that was not included in the underwriting, and that's approximately $25,000 per year. So that will help repay CHFA opportunity loans, or could help if there was any unforeseen increase with the operating expenses. And I can take any questions.
So when we look at the floor plans, when they split up the 27 units and the 55 units, how are we going to use Kiowa to separate the 4 and the 9? Is it by floor? Is it a section of the building?
Yep. So the first 3 floors are split. I believe it's down the middle, and then the 4th floor is all 9%.
And we can't just sort of mingle and kind of average. Why do we have to do it that way?
I think ultimately it comes to the 4-9 structure. They really have to be separated out, and the costs have to be clearly delineated. And it also, for compliance reasons, I think you've got to look at it separately.
Yeah, Heidi, primarily the way the hybrid language is drafted, there has to be, as Colette said, a separation of expenses, identifiable separation of expenses. And so you'll find in these hybrid types of structures, and we haven't done many of them,
Right.
that you have to have this delineation, and you can't have them mixed in for a variety of reasons. So.
And that being
That's
said, the tenants shouldn't be able to tell. So like if you
Yeah.
went to the building, you wouldn't say, oh, I'm on the 4% side or the 9% side.
They could have a baseball team,
Yeah.
against the
They will have a
fours.
beautiful new baseball field next to them. So that is something that is a possibility.
Yeah, I mean, I guess we always keep going up and up and up on the per unit, and I really appreciate you sort of looking at the debt per unit at the end, but the costs, I mean, at some point, it's almost not worth it. But we're cleaning up a brownfield, we're reusing a building, I get it. It's amazing how expensive it all is.
Yeah, and Heidi, I've always been on the same page with you on these costs, but in this particular instance, and you'll see a subsequent deal that's coming up, actually both subsequent deals coming up, we're addressing several social issues here in one project, but it's not just our funds that are coming into the deal to address those issues, right? So we have a brownfield remediation, we have CIF money coming in. We have DEC brownfield remediation money coming in to address that. We have a desire to maintain and adaptively reuse this 4-story factory building, right? And so there is let me see, there's $9 million in federal historic tax credits coming in here, and there's $9 million in state historic tax credits coming in here. So in this particular instance, I don't see this as just the development of affordable housing.
Yeah.
I see it as multi-layered, right? So we have affordable housing, we have brownfield remediation, we have adaptive reuse, and we have historic preservation all layered together. And there's sources coming in to help supplement all of those different social causes, right?
Yeah.
And so we tried to break it down for you here. We're trying to look at these things, we're trying to make sure that we're looking at these things the right way in terms of costs. And we're trying to break it down so we can do a fair comparison of cost versus cost and take out some of the other additional noise that gets in there.
So just staying on that point though, Heidi, because we talk about this a lot, but when Colette just broke it down, I mean, you hear all the participants, the most difficult thing is the scorekeeper here, figuring out how to get everybody to the table.
Yeah.
It's 1,000 people at the closing.
I was gonna say, do you have a conference room big enough?
Right. So at the end of the day, though, I think what we can learn from something like this one is that some things are worth bringing that many parties together. When you look at the end result, this is a site that would be problematic for years and years. Nobody's going to touch it because of the sophistication you need to clean it up.
Right.
And this actually works. The amazing thing is one little slip in the stack and you wonder what's going to happen. Everything has to come together, but very complicated.
Yeah, and if I may just add a couple of points. So what we're also seeing, and especially now that we have access to the market rate development world, is this would never be a project that a market rate developer would touch because of all the additional inherent costs. These types of deals won't pencil out for market rate developers. On the other side, the market rate developer is looking and is willing to pay premiums for your clean, developable sites, right? So it's hard for an affordable developer to compete in the regular market to acquire those types of properties. And so these types of properties become a lot more attractive to an affordable developer because they're not competing against some of the market developers out there. So we see a lot of this because this is what's available, and as sites become harder and harder to obtain, I think, we're going to continue to have to adapt to these types of applications.
Okay. Any other questions or comments? That was a good job, a very complicated financing structure. Okay, is there a motion?
Motion to approve.
Thanks, Greg. Second?
I'll second.
Okay, is that Matt?
Yes.
Okay, thank you. Okay, Dawn, could you call the roll, please?
Absolutely.
Heidi,
Hi-
just a point
Yeah.
of clarification, we can
Sure.
vote on A and B, correct?
In my world, that's most efficient, yes. If you have, obviously you can vote approve one and not approve the other if you want, but let's just have the vote saying that you either approve or not approve A and B.
Very
Okay,
good. All right. Roll call for Tremont 4% and 9%.
thank you. Yep.
Wendy Clark,
Yes to both.
Heidi DeWeingart,
Yes to both.
Claudio Gualtieri, Matt Puglisi,
Yes to both.
Greg Ugalde.
Yes to both.
Great, thank you. Okay, next up on our agenda is the resolution regarding financing of the Monarch, which is located in New Haven, and to be presented by Sarah.
Afternoon, everybody. For the Monarch, we are requesting approval for tax-exempt bond proceeds to fund a first mortgage of up to 14.6 million. This is inclusive of a construction loan of approximately 6.4 million, with interest-only payments for up to 24 months, and a perm loan of approximately 18.1 million, with interest-only payments for 2 years, and then fully amortizing for another 40-year term. There's also a request for a subordinate mortgage of up to $1 million with a 42-year term. Payments on this loan will be made from no less than 35% of adjusted cash flow following the repayment of the deferred developer fee. These loans would finance the new development of 64 apartments in the West River neighborhood of New Haven. The current structures on the site are vacant buildings formerly used for various laundry and auto businesses, will be demolished, and environmental remediation will occur on the site prior to the construction of the new housing. All 64 housing units will be LIHTC eligible and affordable to households earning between 50 and 80% AMI, with the higher AMI bands being served by utilizing the income averaging set aside. Affordability restrictions will remain in place for 40 years. The proposed mortgager is Monarch Apartment Homes LLC, which is a partnership between Hot Meadow, which is the development arm of Vesta, and Honeycomb Real Estate Partners. While relatively new entities to working with CHFA, both have significant experience with LIHTC and housing development, and together recently closed and began construction on the Camelot in West Hartford. The GC will be Innicon, also a relatively new entity to work with CHFA, and also the GC on the Camelot in West Hartford. The ownership team at Innicon has been developing real property in New England for over 35 years. Both the architect, Cross Key, and the LIHTC investor, PNC, have substantial experience working with CHFA on LIHTC deals throughout Connecticut. Based on the CHFA Commission market study, we expect the development to be well received by the market, with a strong need for affordable housing in New Haven and specifically in this neighborhood, which also has convenient access to downtown as well as the local universities and medical facilities. In addition to the CHFA financing, the project will benefit from funding from DOH state bond funds, the City of New Haven's Livable Cities Initiative, 4% LIHTC equity, and also DECD brownfields funding. The city is also providing a tax abatement for 15 years, which is estimated to save about $6 million to the project over that time period. If all goes as planned, we expect to have a final financial closing and construction start in spring And the units would be online by the summer of next year. And with that, I can open it to questions.
I think you mentioned in it that there might be some concern about the capacity of the developer or the construction team. Can you speak to that?
Yeah, so this team, as I mentioned, the same team also just closed on the Camelot. I will say that closing happened very quickly, and now construction is underway and going well at that site. And I think they also, half of the development team, just the Vesta side of it, is part of the ownership of MLK, which was presented at the last mortgage committee meeting in Hartford. We are in the process of closing that deal now. The development team provided us with a sort of separation of responsibilities and duties, which they think will mitigate the concerns about capacity. So essentially, different people are going to be in charge of different parts of the development and the property during the closing and construction periods as a way to make sure that there is full capacity as needed throughout the entire process.
So are you comfortable that they have the sufficient manpower and knowledge, experience?
Yes, Heidi, we are. If you recall, we brought this up when we presented MLK back in, I think, November. So we have our eyes on this. We appreciate the fact that they're separating duties. And again, we've taken a look at them. We'll continue to watch this closely. But the teams themselves are experienced outside of CHFA in terms of development, and we're comfortable that they'll be able to deal with this capacity.
Okay, anybody else? Questions, comments?
Just to follow up on that, Heidi. So, Pat, do we have, and this is for like an overall question, do we have the capabilities that if somebody was to like struggle on this and we identified it, because people are watching it closely, do we rely strictly on the borrower's team just so that there's no lender liability issues and things like that? Or do we have the ability to step in and help when needed?
We have the ability to step in, and we offer a tremendous amount of guidance along the way. We have a very strong tech services team with a lot of experience. So we can step in when a project is failing, but that's sort of a last resort option. We don't, that's not something we would want to do immediately. We haven't seen many projects not get across the finish line. Some have stumbled, obviously, and we've worked with them to move them along. Several projects last year, we played a very participative role in moving them along. We'll have, if we find somebody struggling, we'll have weekly meetings with them, or even more frequently than that, to make sure that they're doing everything that they need to do. So we keep our eyes on these things, Greg, to make sure that they don't get to a point where we need to step in.
In my old life, we used to try to say, we wouldn't fund or lend to any organization who was working with us to do, 100 units or more than 1,000 units.
Right.
Do we ever have anything like that where we would just say, you don't have the capacity, so, come back when you're done with a project?
We always have the right to say that we've determined that you don't have the capacity. We've had some internal conversations about whether there should be set strict limits, but I don't necessarily think that's a proper thing to do, because obviously there are some that we would adjudicate as not having capacity if they have a small number of units, whereas some have the capacity to do larger amounts. So it's really just knowing our borrowers and developers and understanding what they have in the pipeline and what they have for capacity. So it's a tough thing with this group, with both Honeycomb and Vesta. We are going to make sure we understand what else they have coming down the pipeline And before we decide to move them along with any future deals, we're going to have to determine that they've made proper progress with these 3 deals.
Okay, I agree with that. I think it is somewhat subjective,
Hard,
and
yeah,
but yeah, keep an eye on them.
will do.
Okay, any other comments? Okay, hearing none, is there a motion?
So moved, Wendy.
Oh, thanks. Is there a second?
Second,
Okay, Greg, thank you. Dawn, let's do the roll, please.
Sure. Wendy Clark,
Yes.
Heidi DeWeingart,
Aye.
Matt Puglisi,
Yes.
Greg Ugalde.
yes.
Okay. Next on our agenda is the resolution for financing of the state and chapel development, also in New Haven, to be presented by Stephen Norris.
Good afternoon. Yeah, I'm gonna go over state and chapel development. The board action is to approve a permanent only first mortgage loan of up to $13,500,000 from taxable bond proceeds, and also this construction to permanent subordinate mortgage of up to $1 million from the opportunity funds. Going into the details of the first mortgage loan, it may be evidenced by one note in the principal amount of up to $13,500,000 at interest rate of up to 6.20%. And that will have a permanent term of 40 years, amortized over 40 years. Amortization will commence upon the earlier of the 25th month following initial closing, or when final closing is achieved, and continue through the 40-year permanent term. The subordinate mortgage loan may be evidenced by one note in the principal amount of up to $1 million at interest rate of 1%, with a construction term of 24 months, and then a permanent term of 40 years. During the construction term, interest shall accrue on the outstanding principal at a rate of 1% per annum, payable interest only during that 24-month period. And during the permanent term, it'll accrue interest at interest rate of 1%. During the 40-year term, with annual interest payments due each year of the permanent term, and principal payments of 25% of the balance of adjusted cash flow due after the deferred developer fee is paid in full, and also a portion is paid to the subordinate lender. Going to some details about the development itself. State and Chapel Development received an award of 9% low-income housing tax credits back in 2022. The development consists of a total of 4 buildings. 1 building is new construction, and then 3 of the remaining 3 buildings are adaptive reuse. It's on 1 acre in downtown New Haven. The overall development consists of a total of 76 units, and also has 23,000 square feet of commercial space on a prominent active street corner. Going into a little bit more details on the buildings, the development is comprised of a vacant parking lot on State Street, and that's where the new building will be constructed, and that will contain 44 apartments. Adjacent to that on Chapel Street is 3 existing historic buildings that will undergo gut rehabilitation. The historic buildings support commercial tenants on the first floor, and then it's currently vacant office space on the upper floors. 32 apartments will be created on the upper floors. And just to give you a couple examples of some of the commercial tenants, they currently include a post office and also the Dollar General store as well. Going a little bit into the income or the unit mix, the development will include 18 studio apartments, 19 one-bedroom, and 39 two-bedroom apartments. There'll be 15 units for households at or below 30% of AMI, 31 units for households at or below 50% of AMI, 14 units for households at or below 60% of AMI, and then also 16 unrestricted units. 16 units will provide supportive services for chronically homeless individuals, and that will be with the support of Columbus House, Inc. And then also 38 units will receive housing choice vouchers. That's Section 8 project-based subsidies. Going a little bit into the development team, Beacon Community Services LLC is the developer for this property. We do have extensive experience with them. They were the developer in 3 9% transactions, which include Montgomery Mills, Monterey Place and Parkside Village. Some additional properties they worked on in CHFA's portfolio are the 3 phases of Southwood Square, 9th Square, and then also Edith Johnson. The project architect is going to be the architectural team. They are a Massachusetts-based firm. We also have extensive extensive experience with them as well. Some of the completed developments they did under our portfolio are Schoolhouse Apartments, Frost Homestead, East Haven High School, Watertown Crossing Village, Capital Town Towers Apartments, Billings Forge, and Edith Johnson as well. The general contractor will be Montagno Construction, which we also have some experience with. One of the CHFA funded developments they completed is Brookfield Village. And then lastly, Beacon Residential Management Limited Partnership is the property manager. There is an identity of interest between them and Beacon. But we do have experience with them as well, as they manage 9th Square and the 3 phases of Southwood Square as well. Going a little bit more into the location and market summary, the development is centrally located in New Haven, as I mentioned, which gives the residents easy access to several amenities, including grocery stores, pharmacies, libraries, and schools. There's also a bus stop, which is a 0.1 mile walk away, so that's very close by. Yale New Haven Health Center is approximately 1 mile away. And then New Haven's Union Station is also about 0.6 miles away. We did commission an appraisal and provided the prospective as complete value of the property at $15,740,000. This is as of November 8th, 2023. The loan to value ratio for the primary loan is 85%, and the loan to total development cost is 25%. Going into the financial structure, the total development cost of the project is $55,806,000, which represents a per unit cost of $734,000 or $575 per square foot. So as kind of mentioned before, this is adaptive reuse, so it's kind of similar to Tremont, where there are slightly higher, per unit costs. The construction costs total $30,242,000. Or approximately $397,000 per unit, or $312 per square foot. These construction costs, we did compare it to other projects in our portfolio, and they are comparable. Going into the source of funds, there are several funders in this deal. Outside of our financing, there's a $16,555,000 and 9% LIHTC equity. $7,100,000 in DOH funds, $3,876,000 in federal historic credit net proceeds, the $4,329,000 in state historic credit net proceeds, $2,500,000 in Urban Act funds, $2 million in New Haven ARPA funds, $2 million in Blue Hub subordinate financing, $276,000 in 45L credits, $1,600,000 in the GP loan that Beacon's putting into it, and then $2,005,000 in deferred developer fee. Then lastly, going to strengths, challenges, and mitigating factors. The strengths are the project will create 76 new affordable housing units, as I mentioned before, with many amenities nearby. Also, there will be 3 vacant buildings that will now be adaptively reused. We also have, with the developer, extensive experience with them. The development will promote economic integration by creating mixed income housing with 16 market rate and 15 very low income units. And then lastly, CHFA will be paid at least interest only on the opportunity funds each year, beginning at construction loan closing. Some of the challenges are CHFA will be locking the interest rate at construction loan closing and not dispersing funds for 2 years. So during that time, interest rates could change significantly. Construction risks and challenges include recognized supply chain issues, delayed receipt of construction materials, and the potential for continued price increases. Thirdly, the use of many types of funding poses challenges in coordinating all parties for closing and disbursements of funds, as well as managing different compliance requirements. Just kind of speak briefly on that. We are beginning weekly calls with all the funding, with all the funders, so that way we can hopefully manage this for an easy close. And then the development has high cost per unit, with a per unit cost of $734,000. The high cost per units are due to 3 and 4 buildings being adaptive reuse, as I mentioned. And then the acquisition of existing building and land is also a significant driver of the high cost. And then lastly is the mitigating factors. The developer has a positive track record with CHFA. Developer has made clear to all partners that a quick closing is expected. So as I mentioned before, we are beginning our calls to ensure a swift close, hopefully. Developer has a lot of experience, has worked with all the funders in the past. The general contractor has been actively constructing since the beginning of the pandemic, with little interruption or impact to scheduling. And then lastly, CHFA has minimal risk during construction, as opportunity funds will be used during construction. The CHFA permanent loan will not be funded until construction is complete. So I'll open up to any questions.
I would love to see in both this deal and the other ones, a list instead of in paragraph form of the financing sort of sources of funds list. So you could see all the different, make it clearer, all the different sources.
Yeah, Dawn, can you move forward to the next sheet? So Heidi, if you look at this sheet, the very top of it where it says sources,
oops,
it breaks down all the sources. And I was actually going to direct you to this if you wanted to discuss the $734,000 per unit cost on this. So that was
I think we get why
coming into the meeting today. I was going to guide you here. So this is actually a breakdown. You get this on every one of the write-ups that you get, and this breaks down each individual source. So this is a good way to see the different layers involved in here and show what our contribution is comparative to everything else that's in the deal.
So I'm going to throw this out there, and not for today, but I think maybe we could throw it on the table and try to see if we could make it work. It would be very interesting, just as case study to start. But if we took, for example, these loans that are very good, Steve, that was great how you pulled it together too and explained it. But if we used this as, okay, here is current day what it would cost to do the project the way that it has to be done, versus let's take a look at if a developer came to us with a little bit more of a white sheet and said, I know that this is where we're going, this is what we looked at per unit. Using those same funds in that same framework, you could probably get double the number of units if we figured out what adaptive reuse flexibility we had, historic necessities that we have, even some of the cleanup. I think if we had more flexibility in the process in using this as an anchor, because right now there's really no incentive, because if you did that, you would just get tied up forever and never be able to move. But those are significant dollars that I think that we could make go a lot further if we created a path forward that allowed developers and some of these good, strong players to do so. I think we could double sometimes, or at least increase the units, or conversely lower the cost. But either way, I think that today is just a great example of how many people consider the seriousness of creating housing in this state, but maybe there's a better way to do it also.
Don't disagree, and we'll probably have to follow up with you, Greg, to make sure that we are moving in the direction that you want us to move in terms of analysis of this. But as you say, I mean, this is a demonstration. You know, they say it takes a village, right? But for us to develop some of these properties, it takes a state, it takes a city. I mean, the city's got funds in here. There's 3 different state agencies that have funds in here. You've got three different types of tax credits that are in here. And that's all to get 76 units in highly prized area of downtown New Haven. So these are very complicated and difficult deals. This deal in particular has taken a tremendous amount of effort on everybody's part to get it put together. It's been put together and then fallen apart and put together and fallen apart numerous times since 2022, probably even
Correct,
sooner
yeah.
than that, right? And Beacon actually bought the property. They took the $8.9 million risk to acquire this property in 2020. So everybody, it's taken everybody's contribution and thought to make this thing work. And these are complicated deals. So, but we'll try to get you what you're looking for going forward.
Yeah, I'm not sure I understand what you're looking at, Greg. I mean,
I
you're
wasn't,
trying
I
to.
didn't either.
Sorry, Greg, you're way over our heads.
So and I'll just end with this, because again, we sort of get pressed with an agenda like this. But if you took all the money that we are able to pony up on all these different transactions, and you look at the cost per unit and so on, just the whole thing, if we were able to get the people from the state that are starting to profess the need for housing affordability and write down the list and just simplify the process, but even on specific sites, to recognize that with a better framework and probably giving flexibility where it's deserved, I think we could do a lot better. And it's going to take some work. I'm not saying somebody's going to click their fingers and it's going to be done, but it's just when you see those numbers, like Pat opened with saying, and now that we see what the profit side can bring in creating housing, again, pristine deals and stuff, not, unfortunately, we have a lot of work to do in the state to get these deals done as well, but I think there's room there for improvement.
Yeah, and Greg, I think probably the best place to start is to take a hard look at what we're seeing on that for-profit market rate development side as sort of the baseline, the compare. Now, we're never going to get there. Let's not fool each other. We're never going to get this affordable development at the same cost that you get at market rate. It's just not going to happen. It's not, especially with tax credits involved, it's not going to work that way. But at least we have a benchmark that we can work toward, right? So we'll take a look at what we're seeing out in the market rate development projects and see how it compares. And I think that will give you a sense of, if we were more efficient with the use of these funds, where we might be able to get to in terms of units that we're able to develop.
Okay, well, I'm glad you understand, Pat.
I think I do, Heidi, but I'll probably be following up with Greg.
Well, I mean, in
We've talked
simplistic
about-
terms, at
Go ahead.
734,000, can you build 2 units at,
Right.
375 each to, anyway.
Yeah,
But you guys can work
Yeah,
together.
we've
Go
talked,
ahead.
Pat, we've talked a lot about creating efficiencies in our process.
Yep.
Right? It's something we're going to look at going forward, and it requires looking at the procedures and the guidelines and a whole bunch of other stuff that's, sort of in the details or the weeds. But I think what's confounding a little bit for me is that when you've got 12 different sources, you've got 12 different requirements.
Yes.
And I don't know how we're going to make progress on the whole thing if each deal is going to look like this lasagna thing, right? It's
Mhm.
like, and as Pat was saying, like, if you only have these sites that are requiring so much remediation going through affordable housing processes with CHFA and DOH, you're going to end up looking like this every time. So it's
Yeah.
just, it's almost like we have to make a decision that we're not going to do sites like this, or, I don't know. I mean, it's really a difficult question. We're going to have to grapple with it a little bit.
I feel like it's our specialty, and that if we don't do it, who's going to do it?
Right.
There's that.
And that's why I think the specialty needs now to take steps in the direction of, Our team is making calls on this to get these deals done. With more flexibility in the ability to ease restrictions and ease some of the complexity in places, you're going to start seeing a net of 3 units per project, 1 or 2 units, and pretty soon it's going to be real numbers, because this is so complicated. Exactly what you said. Each layer is more complicated than the next. The cost of putting together a Kiowa deal to split up 4 and 9 is probably the cost of half a unit by the time the legal work gets done on that. There's just a lot of places, and again, it's not for this call, but it's definitely doable with the sophistication. And you hear me say this all the time. We have a team that can actually tackle things like this. Not in every state could it be done, but it's so critical in Connecticut, and we can do it. And I think we should.
Right. Another thing to remember is that this deal was awarded 9% credits. And our 9% credits are awarded based on a competitive scoring methodology that uses a variety of incentives that are based on the state's sort of valuing of certain types of policy goals. And, you know, for example, environmental sustainability, supportive housing, which tend to be very, you know, low income. And if you don't have, you know, the income coming in from certain units, then so you've got a whole bunch of stuff that contribute. But those are sort of the distillation of all of the policy goals of the state, right? The QAP represents that. So there's a lot going on, but definitely worth looking at for sure.
Okay, any more comments? Any questions? Okay, I'll move the project. Is there a second?
Second.
Thanks, Greg. Okay, Dawn, could you do the roll, please?
Of course. Wendy Clark,
Yes.
Heidi DeWeingart,
Aye.
Matt Puglisi,
Yes.
Greg Ugalde.
Yes.
The vote passes unanimously.
Thank you. Okay, next up is the resolution regarding the reservation of low-income tax credits for Curtis Cofield 2, to be presented by Carol.
Hi, good afternoon, everyone.
Hello.
So staff is seeking authorization to approve a return of 2022 9% LITAX in the amount of $1,319,929 and approve a new allocation of 2024 LITAX in the same amount to fund Curtis Cofield, which is the new construction of 56 new apartments in New Haven. The developer is NHP, they're a nonprofit in New York City. So there was a substantial delay related to the remediation of the site by the city of New Haven, and the anticipated 18-month construction schedule was significantly delayed beyond the current placed in service date of December 2024. Which, if that occurred, would result in the loss of its current LIHTC allocation. An allocation of 2024 LIHTC would then establish a placed in service date of December of 2026. The current projected construction completion date is February of 2025. So the site, as I mentioned, was previously owned by the city and was transferred to the owner in conjunction with the closing of the construction financing in November of 2023. Prior to the transfer, the city completed the required remediation activities to comply with federal and state regulations. However, during that process, they encountered a lot of unidentified materials that was not identified in the phase 1. So that remediation took much longer than anticipated and kind of threw off the entire construction schedule. So CHFA is providing construction to permanent loan financing funded with CMF and opportunity funds. And so at the construction closing, CHFA provided the developer a comfort letter that allowed them to request a return in exchange of the 2022 LIHTCs for an allocation from a future year's credit ceiling. The LIHTC syndicator and the construction lender limited their funding at closing. And so construction is being funded as of now by the city of New Haven. They have $1.5 million in the deal, as well as DOH. That's all I have. Any questions?
How far along is the project?
They just commenced construction in December of 20. Yeah, so it's like 1 month into construction.
That's fine.
But they have 1.5 from the city and approximately 5 million from DOH. But the syndicator and the construction lenders, they're not going to be funding until this return exchange has been approved.
And it doesn't impact our future allocations if we return one and get another in exchange?
No, it does not. I just learned this myself back in September. What the best way to say this is that the 2022 credits get returned and then they get reclassified. So we take in the 2022 credits, we issue them 24s, so we extend their placed in service date, and then we reclassify the 2022 credits as 2024 credits. So no impact to our credits.
But the tax syndicator has to approve it because they still need to be willing to purchase the credits, correct?
No, they've already agreed. They're already under contract to purchase the credits. They just they wouldn't agree to fund their amounts at closing until we've extended. So we were able to work through that. Carol was able to work through that closing.
Okay.
We got the closing done, and now with this return in exchange, the investors will start contributing their funds.
Okay. So this is their only condition, I guess.
Only
Yes.
remaining condition, yes.
More questions? Comments? Okay, is there a motion to approve the reallocation or exchange of credits, tax credits?
So moved.
Thank you, Wendy. Is there a second?
Second.
Thank you, Matt. Okay, Dawn,
Of course. Wendy Clark,
Yes.
Heidi DeWeingart,
aye.
Matt Puglisi,
Yes.
Greg Ugalde.
Yes.
Vote passes unanimously.
Thank you. Okay, now we have the resolution regarding the reauthorization of the small multifamily community development financial institution loan pool. That's a mouthful. By Terry.
Yes, thank you, and good afternoon, everyone. You have before you a request to reauthorize an extension of the small multifamily CDFI loan pool program through January 31st, 2029. This extension will enable the participating CDFIs and any others that are approved to participate to continue utilizing the program and to bring vacant and rundown apartments back online. The program has been in place since 2014 when CHFA launched it with an initial $5 million investment. Since then, the program's funding has been increased by $2 million from ITA funds in 2017, and then again by a combination of ITA and OPM funds for transit-oriented development in the amount of $6 million, and in 2022, by $4 million, again from CHFA and OPM at $2 million each for responsible growth projects statewide. In January 2023, the board authorized an extension of the existing program for a period of 1 year to enable staff to explore program improvements and enhancements. This board authorization will expire January 31st, 2024, so tomorrow. So currently, since the program was reauthorized. 3.1 million has been requested and is in process, and another $3 million in requests is anticipated to be made in the coming months. The balance available for the program is approximately $11 million. There are currently 2 active participants, Capital for Change and Hartford Community Loan Fund, and we will continue to outreach for additional participants so that we can increase our reach statewide. So again, this is seeking your approval to reauthorize the program for another 5 years through January 31st, 2029. And I'm happy to answer any questions.
So why do you think we only have 2 active participants?
Well,
Is
we
it-
were looking for CDFIs only, and there's you know, a good fair number in the state, but only maybe 4 or 5 that were doing housing. So when we initiated the program, we did some specific outreach to those we already had relationships with. And that's how we started with just Capital for Change, Hartford Community Loan Fund, and HDF in Stamford. Now, as we want to broaden the program, we're looking at anyone who could, you know, credit unions, CDFIs, anyone who could manage a small loan portfolio. And the CDFIs, though, do provide outstanding technical assistance and support, so they make a really good fit for this program. LISC has expressed an interest in joining, so we're looking to finalize something with them as well. HDF has explored rejoining. They hadn't utilized the program previously, but they're interested in doing so now, so we're working with them as well. That'll get us a little bit more statewide reach, and we're looking to see if there's any further participation we could get for, say, Eastern Connecticut, or more statewide participation.
So can these funds be used for additional subsidies to end buyers? Or is this used in construction programs?
This is used by the CDFIs to fund small investors who are purchasing and rehabilitating vacant, dilapidated, uninhabitable properties. So you'll often see them in communities where there's, you know, it brings up an entire neighborhood, because you'll have buildings on the street that are boarded up and uninhabited, may have 6 units in them that no one can live in. So the CDFIs will lend the proceeds of our loan pool in part to the investor, and then bring those back up to code and have low and moderate income residents. Does that answer your question?
Yeah, no, understood. I was thinking of the perspective of a credit union, and some of the issues that they're facing about filling the gaps for folks who are ready to buy houses, but they just can't find anything in their price range. That was all. And at what point is the money allocated to the CDFI and their identifiable, ready to go projects?
Right. So the developer, the person who's going to be working on the property will submit their application. It goes through the underwriting process at the CDFI level. When it's been approved through their loan committee and they're comfortable that it meets all of our criteria, they will submit to CHFA the loan package, which has their underwriting, their approvals, justification, and a draw request. And at that time, when we've received a signed note in hand and the signed agreements that we require, we will issue the funds to them. And we go through our own due diligence too, to make sure that everything meets the requirements of the program.
Thank you, Terry.
So one question too, Terry. So we're looking at $11 million. Let's say that we did have some success bringing, because I think with the attention now on housing affordability, let's say that we had a chance to go well over that, or we start inhibiting the 2 producers right now if we have to balance it out between a lot of different players. It just seems to me that you always run a risk if you're one of these entities that you could be capped or in a different sharing percentage method. Do we have the ability to grow that if we really did try to expand this and bring more people and get more people and more lenders involved?
We're, Greg, we're keeping our eye on this. We actually had contemplated asking the board for an additional allocation, but at this point, we have around $12 million available. And we're gonna monitor the use of those funds from the existing CDFIs and anybody that we add. We may come back to the board at some point, and hopefully we do have to come back to the board with a request to add additional funds into this small loan pool so that we can accommodate even additional growth. It's been a very successful program. It's been very useful. I think everybody understands that a tremendous amount of Connecticut's affordable housing stock comes between this, 2 and 20 unit range. It's very, very difficult for us to do these small projects because of the lack of efficiency. So these CDFIs are great partners in terms of putting this together. So there may come a time in the very near future that we're going to come back, and we're looking at other alternatives to seeing that this fund gets continued funding.
And I wonder if we have enough personnel to do the reach out, which I imagine is also time consuming.
Thank you, Heidi.
We're working on that, and we're working on that internally as to how we'll go about attracting additional players, and if at any time we ever need to add staff, we'll certainly make that addition.
Okay, thank you. Any other comments? Okay.
I'll make a motion to approve.
Thanks, Greg. I'll second that motion. Dawn?
Wendy Clark.
Yeah.
Heidi DeWinker.
Aye.
Matt Puglisi.
Yes.
Greg Agalde.
Yes.
The vote passes unanimously.
Thank you. Okay, next up is approval of the minutes from the mortgage committee meeting a lifetime ago, November 28th.
So moved.
Thank you. I'll second it. Is there any comments before we vote on it? Okay, Dawn?
Wendy Clark.
Yes.
Heidi DeWinker.
Aye.
Matt Puglisi.
Yes.
Greg Agalde.
Yes.
Okay.
Vote passes.
Thank you. All right, next up is I guess the residential mortgage report. Is that next on the agenda? No. Yes, okay, thank you. Kayla,
Yep. Hi, good
Okay,
afternoon, everybody. I know we're a little over time, so I'll try to keep it brief. So this is the 2023 summary report. So the numbers herein are going to be capturing all of the production that we did last year. I want to start off with a little bit of a market update, just kind of a summary of, what was going on in home ownership. So in 2023, the name of the game was really interest rates. So this is looking at interest rates, all the way back to 1971. And so even though the conversation has really been about how high mortgage rates were in 2022 and 2023, there is, a little bit of a look back like, oh, it was much worse back in the 70s and 80s. But I think something I sort of point out on this graph is that blue line that shows the year over year change. And we really saw a spike up in 2022. And then prices, we saw more growth in 2023. We look at that green line of interest rates, up into that 7.5%, almost 8%. And then if we click over to the next slide, we'll see that, these higher interest rates actually help to make CHFA homeownership products a little more competitive because our interest rates are lower than the overall market. So you can see in that green line, that's the average 30-year fixed rate compared to the average CHFA rate in the orange line, which, throughout the year tended to be a little bit around 0.5% lower. And that really does help our borrowers, especially those low to moderate income, first-time home buyers, where, that 0.5% really makes a difference in your monthly payment and over the life of the loan. If you want to take to the next slide, Dawn, we'll see that, you know, our first mortgage loan activity really shot up this year compared to 2022. That competitive advantage and some of the products that we offer really helped to bolster those numbers. We had 3,147 loan purchases in 2023 for over $737.5 million. And then if we take a look at that next slide, I just wanted to highlight that growth the year over year. So earlier this year, the Commercial Record, they released who the top lenders are, who the growing lenders are in the state. And CHFA was Connecticut's fastest growing lender in 3 out of 4 categories. So residential loan volume, which is just, you know, the number of loans, residential loan production, which is the dollar amount, and then also on our multifamily side, our loan production was really, really up in 2023, which is great considering what a tough market it really is for first-time home buyers. And taking a look at the next slide, Don, thanks. Our first mortgage lender activity, you guys should be pretty familiar with these names by now. These have been our top lenders for a really long time. First World Mortgage had over 800 loans with us this year. And I wanted to point out that our top 5 lenders originated 58% of all of the loans that we did in 2023. So our relationships with them are really important. And, you know, we've really been working to foster that, do lender trainings, and really engage with these lenders to make sure that we continue to be good partners with them and them to us. As for our down payment assistance program, we also saw high utilization of these programs this year. We did 2,639 down payment assistant loans. And I did want to point out that these loans are distinct from the time to own down payment assistance. So this is just, you know, CHFA's DAP. And then if we take a look at the next page, we can see that time to own utilization. You know, of those 3,147 loans, over 2,000 of those borrowers also utilized the time to own program to help lower their first mortgage amount. Time to own was used across 135 different towns in the state. And since the program launched, we've seen over $100 million be reserved under the program, with the average amount for the TTO borrowers around $30,674 of assistance. Looking at our total loan program, we saw loans in 142 of 169 Connecticut towns. So we're really out there, you know, trying to promote our programs and make sure that everyone has the opportunity to use them that can. And then as for our demographics, you know, who are we lending to? Who are our borrowers? Over, you know, just under 52% of all of our borrowers this year identified as BIPOC. And this is an increase over last year, which I think really speaks to CHFA's commitment this past year to really targeting outreach to BIPOC communities and making sure that the programs are available and understood throughout the state. And then if we get to the next slide, kind of highlight a couple of these events. So by the end of the year, CHFA had attended over 60 different outreach events across 25 different communities. In addition, homeownership staff hosted 85 lender trainings, and those lender trainings had over 4,000 attendees, and 15 CHFA real estate continuing education classes, where homeownership staff provided training to over 700 real estate agents. Some of the events that we can highlight here were the New England Mortgage Expo, Homebuyer Speed Networking, the Bridgeport and Hartford Latino Festivals, and the Connecticut Affordable Housing Conference, along with many, many more. On the next slide, we highlight just one of those events that really gets to what I was speaking about, our focus on BIPOC outreach. So CHFA attended the 2023 NAACP State Convention. Their homeownership staff, Brian Boyagi, participated in a panel with some of our partners that talked about the Connecticut housing crisis and specifically how this impacts communities of color. We had over 40 convention attendees listen in to this really important panel where we sat alongside representatives from the NAACP, Habitat for Humanity, NHS of New Haven, and M&T Bank. And so along with, you know, promoting CHFA first mortgage products and, you know, how they can be used to help people of color access homeownership, this was just also another way that we really got to engage with our partners who we work with, you know, our banking partners, our nonprofit partners, to really continue to foster those relationships. And then I won't, read this whole thing, but really encourage everyone to read one of the success stories from this year, Fiona Williams, who used a CHFA mortgage product to purchase her home in New Haven. And, it's nice to see the production numbers, but I think, this success story really speaks to what we're trying to do as CHFA and the stories that we want to share to help promote our products and to promote, our place in the market. So with that, does anyone have any questions?
Thank you. Great job. I mean, it's a really good year.
Great. I'll hit it over if anyone doesn't have any more questions. I think Lisa wanted to say a few things as well.
Okay.
Yes, actually, we wanted to ask if it would be acceptable to provide the homeownership report on a quarterly basis. It seems the data in the report doesn't significantly change month over month, other than the amount of transactions and the volume. So, and the overall volume is provided in the board package each month and can be found in the monthly tracking report for single family. So we just thought it might be more impactful to see it on a quarterly basis rather than every month, kind of looking at similar information.
Fine with me. Anybody else comments?
Nice
Quarterly?
work by Kayla kicking it over to Lisa for the big question.
The hard part.
That sounds reasonable.
Great, thank you.
Okay, thank you, Kayla and Lisa. Next on our agenda is the multifamily report. Seema?
Yeah, good afternoon, everyone.
Hello.
Good afternoon, everyone. You can hear me? All right.
Yes, we can.
Perfect. I'll keep it short. So first we'll go to the development spotlight. We are showcasing 80 South Road in Farmington. It closed in a record 3 months from board to initial closing. And there are these renderings, and it's just started construction. 65 units and 15 of those are supportive. Placed in service is expected to be end of this year, with final closing spring next year. All right, multifamily pipeline at a glance. This is data end of the year. So the 3 big tiles on the top, the competitive 9s, the non-competitives 4, and miscellaneous, and the SSHP capital grants. Between these 3 tiles, we have 2,262 million in total development costs, 95 developments, and 6,902 units. And if you shift a little bit to the bottom of this page, done. Perfect. Thank you. So 9% round is under review. We received 10 applications. We have 88 applications open under the HTCC program. With SSHP, we have 24 open applications. And this time around, we added a new tile built for CT. We'll soon start tracking these. And we had our first development closed in 2023. We have a whole page dedicated to that one in a moment. Last time, you all wanted to see year-over-year comparison. So there are these 3 charts comparing the total development costs, units, and the projects for the multifamily pipeline. So the blue bars are for January this year, and the orange ones are for last year. The quick takeaway is the TDC has increased, while the number of units and the number of projects have been quite similar, which tells us what we already know, that the cost per unit has gone up. That was the big takeaway. And let me know if you wanted to see anything else for the year-over-year comparisons. Next tile. All right, this is the big deal, built for CT. So in conjunction with DOH, CHFA closed the first built for CT loan with Belfonte companies of Hamden. And we provided 5.5 million in subordinate financing for a mixed use property with 213 multifamily units. 44 of those are middle income units affordable to tenants making 80 to 100% AMI. And this will save them 6,968 per unit compared to the market rates, market rate rents. This is a rendering of the picture, and it's located very close to CHFA in Rocky Hill, for where the former Ames department store was. All right. In terms of engagements, multifamily staff attended the HFA Institute's Housing Credit Conference held in DC. We had ribbon cutting for the HTCC program, 260 West Street in New Haven. And tech continues to meet with contractors on a quarterly basis. Switch gears appear to be a long lead item still. Other than that, I think most of it is coming back to normal. In terms of the light tech round, we've received 10 applications. This is less than the 19 pre-applications we had received. Several development teams report unable to close funding gaps, and they would look to apply in the 2025 rounds. 2 applications were received in the preservation, 8 in the new construction, and it is very well represented. 2 in Avon, 1 in Cheshire, Danbury, East Granby, Farmington, Naugatuck, Simsbury, and 2 again in West Hartford. And for the HTCC program, Eversource purchased the entire 10 million allocation, and CHFA has issued the HTCC vouchers. Next one. So end of the year was a lot of activity. We closed 11, we initial closed 11 deals between November and December. Yeah, that was a big number. And then we had 2 final closings, Huntington Towers and Edith Johnson. And at the bottom, you will see a table with projects that we in multifamily are reviewing, and they'll be coming to board in coming months.
Is there anything that you're worried about? Any projects or processes, or, I mean,
No,
interest rates coming down?
No, well, interest rates are coming down, and we're grappling with how we make sure that we capture that in our presentations to you, so that we make sure that we have enough room that if by the time we close, there's this space and time between the board approval and when we actually close the loan, that we've sort of made available to us the most amount of mortgage money that we can. So we've been working with Hazim on how to make sure we capture that. We are seeing some stabilization in terms of cost increases, and as Hema mentioned, really the only long lead item that continues to plague all the properties in Connecticut is switchgear. Hopefully there'll be some sort of resolution to that, or workaround, that we can implement on our projects as well. And we continue to see, probably the biggest increases in cost that we're seeing on an operating side are insurance, and we're going to be taking some proactive steps this year to engage insurers in some conversations and some roundtables, hopefully, and see if there's a way that we can help to allay some of the costs to our projects that related to insurance, so that we can make sure that these projects are sustainable. So it kind of the same stuff that we experienced last year, but it's, it does seem like it's starting to stabilize, and we're really, really hoping that these interest rates gets pushed down, because that'll help solve a lot of the gap problem we're seeing with these projects.
Can I just add one thing? I think from the discussions today, if you look at these 2 reports, this is what makes it so exciting. If you look at the ability that we've had to jump in with both feet into the profit side and start really mastering a lot of very difficult issues with primary lenders involved in the fund for CT, and you look at combining the resources in the gambit that we'll be able to cover in comparing both, it's a very rosy future. The problem will be, of course, is financing everything that we'll need to, but it's very exciting when you look at the possibilities of really making even a bigger impact in the state of Connecticut. This is a good year leading into another one that shows a lot of promise for sure.
I agree.
I think it's important to note that in SEMA's comparison year over year that we have seen, you know, in terms of total development costs, we've seen a fairly significant increase year over year, while we're seeing the same number of units being produced by those dollars. So hopefully there'll be some leveling off of that, and that's why you're seeing the complicated deals that you're seeing, because we need so many different sources in order to be able to fund that full TDC stack, right? So we're hoping with some leveling off and some interest rate reduction that we can reduce the number of sources involved, and maybe we can get you to that higher unit count, Greg, that you were looking for earlier.
Exactly. Yeah, it's the inflation effect without, you know, even saying it, but absolutely true. 30-40%.
Yeah, and it's been hard. We've actually, you know, had to come up with these sources, and it's difficult. We hear, you know, everybody likes to compare one number year over year. How many units have you produced? But there's so many factors that come in, and the fact that we as a state were able to essentially maintain the number of units that we produced year over year, I think in the face of the difficulties that we encountered this year, I think is a tremendous success for the state.
Agreed. Okay, is there any other comments, concerns, questions? Anybody on the board or staff? No? Okay, so I guess we have a quick turnaround. Tomorrow's the board meeting.
Yes.
Okay, is there a motion to adjourn?
I'll make that.
Thank you. I'll second it. All in favor? Aye.
Aye.
All right, thanks, everybody. Appreciate
Thank
your
you, everybody.
time.
Thanks.
Okay.
Yeah.
Bye now.